Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. Coming off the heels of last week's WASDE report, corn now sits at a critical threshold. We now see two sequential lower highs, and if we're able to form a third lower high, we're then poised or at the very least set up for the market to make a nice run to the upside as we have been looking for the market to do. Overhead resistance is where the market currently has been holding, and so upon making one more higher low and then being able to break above resistance near 373, this May contract could very well make its way a little bit higher. Although time is running out, with just about a week and a half left before first notice date for this contract, the movement that we would be watching rests with the July contract primarily. From this vantage point, we can see that 361 happens to be a very important potential area of support. It also happens to be the top end range of volatility-based support. And so long as the market is able to hold this 360 to 361 number, we believe the market has a very good chance of turning back up again. As mentioned earlier, the overhead resistance sits at about 371, and we can see a key level here at 374. And so these two areas are going to be very important for this particular May contract. The July contract has a similar formation with a series of lower bottoms. And so this current area where the market is sitting near 367 3/4 is going to be very important for this contract, so long as it does not exceed this previous pivot low that was made a few days ago. Overhead, we see a small double top that was made, and this double top happened to land right at 372, which is the point of control. So it's not unusual for the markets to react off of key points of control thresholds. Upon moving back up to this area, since it has already tested it twice and a little bit several weeks ago, this next go around, once it's able to get through this area, would suggest the potential for a nice advance to the upside and paving the way for the market to make the move to the 400 area that we've been discussing for the last few weeks. Right in the middle of volatility-based support, we find our key 45-degree level of 365.5. That happens to be very close to where the low was recently over the last 2 weeks. And again, market right now is retesting that area. And so for now, we're looking for 365.5 to be the very key area for the market to hold, and then look to break above the 360-degree mark of 375, retesting the previous double top level that we spoke of before to pave the way for the market to make an advance to the top side. The point of control for the December contract is at 386. And that 386 number is exactly where the market is now currently potentially finding some support. We have that same sequential lower highs that we've been talking about before. And additionally, we have our one-by-one angle to the upside that has been doing a fairly reasonable job of keeping the market on target as far as higher lows. Additionally, here we can see the market has made a couple sequential higher highs as well. And so when the market starts to make a move like this, making one more higher low would suggest the potential for a very fast move to the upside upon the completion of the fourth higher low. The key areas to have on our radar for the December contract will be the 180-degree mark, which rests at 382 3/4, and then overhead price threshold for potential near-term resistance would be at 402.5. The continuation pattern in soybean that we brought to your attention a couple weeks ago yielded the price target that we anticipated the market reaching. The distance covered from the movement coming into the continuation pattern was a mirror of the actual price action coming out on the other side. Reaching our price threshold of 940, the market actually has found reasonably good support here and has bounced off of this level, even with a small marginal break from that zone. In addition to that, what we also notice is a repeat or a mirror of the actual move prior to the drop into that continuation pattern. So what we see here is a nice sideways movement in the market with a small little spike, with the exact same thing happening on the other side, again with another spike. In doing so, this pattern could very well now be completed, and one of two things could happen. We can see soybean now move on to a very big move to the downside, but if this 940 area is able to hold, we could very well see a change in trend where the market now starts to move to the upside. In doing so, what we would then be looking for would be small movements of slightly higher highs and higher lows, but at the very least over the next 2 weeks, as long as this price support is able to hold, and if the market simply does a sideways to slightly upwards movement, we will then be able to start seeing perhaps in early to mid-May a summer rally occur in soybean. So for now, this 940 threshold is going to be very important, and we will translate this price level into the July contract. That price horizon reflected in the July contract sits at about 947.5. And now what we can see is that the market now is trading near one standard deviation below the point of control of 960. So this 960 number is going to prove to be a very important number for this particular July contract. If the market's able to make it above this point of control threshold, then the next key area or target that we would be looking for the July contract to potentially reach is about $10.10. Similarly, we can see that our sinusoidal wave has done a fairly good job of containing this price action here. And given that this market's able to hold above the sinusoidal wave, we would look for a price objective to find near-term resistance at 983.5. And upon getting through there, to really be able to test the next upside sinusoidal wave for a potential price threshold target of about $10 or so. The point of control for the November contract seems to be of significance, sitting at 955. This is where we find very good support actually occurring for this contract after having bounced off of support near the 950 area. The market has bounced off of here, and you will also notice how the market did find resistance coming off of the 1-by-1 downside angle. Upon being able to make its way above this area here, we would look for potential upside movement, although the volatility in the November contract might be a little bit less than that of the previous two that we've reviewed. The following two levels have held support and resistance in check for a number of days now. We have 964.75 on the top side, and down below we have 949. These two levels should prove to be key areas for this November beans contract, and upon breaking through in a very clean fashion in either direction, should signal confirmation of direction of strength of trend. So we'll be looking at these two levels in particular to give us a nice indication of where the market looks to go. July wheat is moving as would be expected. The recent highs that we saw was in conjunction with the market being overbought on the stochastic level. This move to the downside now is about halfway down the stochastic movement, and we look for the market to break previous lows at the very least on its way down. A downside potential target would be one standard deviation below the point of control of 420, and so we continue to like that number of 420 as a downside target for this July wheat contract. From this perspective, we can see our sinusoidal wave was the clear indication of the top that came in for this move to the downside. And right now, the market is sitting between two key levels, which is the 90-degree mark of 474.75 and support down below at 431. Upon breaking 31, we would expect swift movement down to that 420 target that we mentioned not too long ago. We've been warning you that crude oil should return to weakness, and after having reached volatility-based resistance overhead, we got a very big move to the downside today, really confirming the move that we had long been expecting. The market had been overbought, and now we're seeing a breakdown, looking to potentially retest previous lows near 47, as we discussed before. But this huge move to the downside is very good confirmation that the market, again, should be returning to weakness. And as we're watching crude oil, we are seeing very much that it is playing in line with expectations. Thank you so much for joining us for our weekly market update. Look so much forward to touching base with you again next week.